So, let's get started.
Okay.
Okay, so we're going to talk today about how to get the equivalent of 90% or more at the sale of your investment property, or the equivalent to 90% net proceeds. So, Bruce,
it could be residential property as well.
Residential. It could be owner-occupied.
It could be, yes.
Or not owner-occupied property. So, Bruce, let's introduce you. You're Bruce Jones. You're the president and founder of Tax Wealth.
Right.
Tell me a little bit about yourself so that the audience gets familiar with you.
Okay. By background, I'm in my 42nd year in financial services. Started off way back in 1970. Have taught the subjects of tax management and financial strategy planning since '74. And for about the first 20 years of my career, it was all general tax planning and financial strategy planning. 22 years ago, I decided to make a more defined focus on the tax planning side and working with professionals such as yourself, and working with you to solve your clients' tax problems to help maximize more profit for your clients.
Fantastic. Well, I can't wait for us to get started and talk about this tool that you have. So tell me more about how you can get 90% or more, the equivalent of that, when you sell an investment piece of property or even a primary residence that might be worth, let's say, $1 million or more.
Okay. Let's start with the primary residence. Let's tackle
Okay.
that one first. You're very aware, as most of your viewers are, I'm sure, that upon the sale of a residence, as long as you've lived in that property for 2 of the previous 5 years prior to sale, that per joint owner of the property, there's a $250,000 tax-free gain that's coming to them.
Okay.
So for a married couple, it's $500,000.
Okay.
So the first $500,000 is gain is going to come tax-free to the property owner where they're living in that property upon sale. So when we're dealing with residential property, owner-occupied property, we're really dealing with properties that have a taxable event above a $250,000 if it's a single individual, or above $500,000 for a married couple. And from a tax planning viewpoint, there's a balancing point as to whether or not, number one, they should even look at tax planning, because sometimes it is better to pay the taxes.
Okay.
When you factor in the costs to do the planning, the attorney fees, my fees, all of those things collected together, sometimes it's actually better to pay the taxes than to try to mitigate or defer them or completely eliminate them. But on the whole, if you're dealing with debt over basis, it can be a huge problem. And unfortunately, most people are blindsided on that issue because they've never heard about it. And they usually never find out about it until after the fact, when it's too late to do something about it.
Once they file their tax returns.
Right. So, may I illustrate?
Yes, please.
All right. This is sort of close to home because this is my older brother's sister-in-law. She has owned commercial property in Sierra Madre for 28 years now, actually a little more than that. She paid originally a little over $100,000 for the property. She has depreciated out a lot of that property over that time frame, and she wants to sell it. And when she brought this up to me, I said, well, how much do you want to sell it for? She said, well, it used to be worth more than $1 million, but in today's market, after costs, I want to net $850,000. I said, okay, that's fine. You do realize you have some capital gains tax issues. Oh, I'm going to do a 1031 exchange, buy another property of equal or greater value, and defer the taxes into that property. Okay. Do you owe anything on it? Do you have a mortgage? Yes, I do. I refied a few times through the years, as a lot of property owners do. And she owed $778,000. And I said, well, you do realize or you may not realize it, but you have another tax problem. Well, what's that? Well, like a lot of property owners, she had no idea about debt over basis. And had she sold the property, even doing an exchange, in her case, she would have deferred about $190,000 of capital gains taxes. But she still would have been handed a tax bill for $250,000 for the year of sale because of debt over basis.
Is that because of her paying the initial $100,000 for the property, but now she had $778,000 on it? So
That's
she
right.
had to pay all that cash out that she took. Now
That's
that
right.
tax becomes due.
Exactly right. In her case, her net basis was $65,100.
Is that her original debt?
No, her debt was $778,000.
No, but I'm saying her original debt, since she originally bought it for $100,000, you said? So
Right.
is that $65,000, was that her original debt? Is that where that number
No,
comes
she
from?
originally paid $100,000
Mhm.
for the property.
Mhm.
And as the property grew in value,
Mhm.
she would borrow from the equity.
Exactly.
Because borrowed monies is non-taxable under law.
Okay, yeah.
So she did this several times and grew that debt ultimately to $778,000.
Which most people do.
Very often the
Mhm.
case.
Mhm.
But they don't realize that the difference between the mortgage to be paid off at close of escrow when they sell
Mhm.
and what their net basis is, which in her case turned out to be $65,100.
Oh.
That difference is fully taxable at ordinary income tax rates.
Even if you do a 1031 tax exchange?